How to profit from a stock market crash for beginners. Market crashes are inevitable and they hurt like crazy. But how a market crash affects you depends on which side of the fence you're on. It might sound a little counterintuitive, but market crashes actually create buying opportunities for those that are smart and quick enough to see them. By changing your mindset and doing a few things differently, you can end up on the right side of history and profit from a market crash, even if you're a beginner. So what should you do to profit from a stock market crash? Keep watching to find out. Do nothing. Stock market crashes are absolutely wicked and so harsh that people can go from 100 to 0 so quick that they'll never even know what hit them. Think back to the financial crisis of 2008 and, of course, the Great Recession that came after. People who thought they had so much security saw their portfolios lose as high as 30% or more in value, and people who cushioned their retirement plans on 401ks saw nearly everything evaporate before their eyes. The thing is, when market crashes happen, people tend to overreact. By nature, humans are reactive creatures and will instantly seek cover on impulse when things come crashing down. This could be a great survival skill, and other times it could be your downfall. Once the crash happens, they start to frantically sell and sell and sell, obviously at low prices. However, there's always a group of people who see the crash as an opportunity rather than the end of the wall. This group of people that sees the crash as an opportunity often start their redemption plan by doing nothing. Sounds weird, doesn't it? Yes, but doing nothing is a golden tip in investing, believe it or not. Panic selling during a crisis almost never turns out well, and when things come back up, which they will, panic sellers end up missing out. So it might be tough and nearly impossible. But if you have your fingers in the market during a crash, best thing to do is to sit tight first of all. Find sectors that increase during market crashes. It might be easier said than done, but the next best thing to do after pausing all investing activities is wisely researching sectors. Start by researching companies and sectors that tend to survive and thrive and increase in price during a bear market. You can do this by researching past market crashes to see which stocks, sectors, or assets successfully stayed afloat or went up when everything else was crumbling and crashing to the ground. There are tons of reputable sources on the internet that you can study and gather the information you'll need for different time frames. You'll then be able to tell which industries outshine others and where you need to put your money. Buy during the crash. Think of a market crash as an all-you-can-eat buffet of discounted stocks and funds. Do this with caution and within reason, of course. One thing about stock market crashes is that they put many companies, stocks, assets, etc. on sale. In a way. As I said, think of it as a buffet where things are discounted and you have been presented with a unique buying opportunity to grab assets while they're at lower prices. Now, not all companies available for you to invest in are the good ones. So if you have a company that you believe in, meaning you've studied and done your research, it's time to go all in and shop. Before you start investing as much as you can, it's important to save enough money to keep you afloat for a period of time. Seasoned investors recommend saving enough for at least the next 5 years, which is the average period markets crash and recover. Invest in stocks and funds that you've had your eyes on for a while and companies that you've looked into at steep discounts. We like to say cheap stocks equal massive gains over time, when done right. If you're not looking to step out of what you have, simply buy more shares of what you already have in your portfolio. The tip here is to buy wisely, not panic sell. We call this buying the dip. Dollar cost averaging. Dollar cost averaging is an investment tactic that allows you to safely go on a buying spree during a market crash. It involves steadily and safely investing a fixed dollar amount regularly, regardless of what the share price is. This allows you to build a healthy investment habit, invest more efficiently, and reduce the anxiety or stress that comes with investing. This is an excellent way to get over your fear of buying the dip at the wrong time. Some people are so scared of seizing the opportunity the market crash presents that they end up freezing and not using the opportunity at all. Dollar cost averaging can help you perfect the effects of your investments during market crashes by putting your money to work within reasonable bounds. It is best done when automated. Dividend investing. Dividends come straight from a company's net income, while stock price will depend on how other investors are interacting with stocks within the market, i.e. buying and selling. If you purchase stocks and the market price drops, things can go sideways fast. However, dividend investing can work in your favor. How? Well, if the company continues to make profit despite the decrease in stock price, their net income still exists to pay you dividends. Dividend investing is an important pillar of education and operation in investing, and every beginner investor should know how to find dividend-paying stocks. This way, you'll know what to look for and choose the right companies. Do it for the long term. As a beginner investor, you have probably heard this 1,001 times, but hey, it's good advice. Never invest with greed or out of fear, and if you want to have the best chances, try doing it for the long term. A long-term investor uses a market crash as an opportunity to improve and increase their portfolio by buying shares in companies that they intend to hold for years. Warren Buffett, one of the world's most renowned investors, often says two things that you need to carry with you in your investment journey. 1. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And 2. Our favorite holding period is forever. Holding stocks long-term could mean years, and sometimes even decades. It can be challenging, especially when the worst of a market crash hits, but you'll need to stick it out for the companies and stocks that you believe in. It's important to note that long-term investing doesn't have to be the only strategy you employ, but it can be a vital part of building and maintaining your portfolio. Sector rotation and diversify. It's obvious that various sectors respond differently throughout rises and falls in the economy. For example, when the economy is in an upward phase, sectors that cater to somewhat luxury, big-ticket demands like big tech, cars, home improvement, and innovation see an increase in sales and income. However, in market downturns, sectors that cater to essential and protective needs such as food, blue-chip energy stocks, easy-access healthcare, real estate, etc. have the upper hand investment-wise. Strategically investing in different sectors at the right time is a great way to put your money to good use. This investment tactic is called sector rotation. Many seasoned investors don't advise beginners to do this on their own, as it requires a lot of close studying, monitoring, and strategy building. You could avoid the challenges of sector rotation by investing in diversified index funds like S&P 500 that allow you to follow a benchmark index rather than individual stocks in a sector. No matter which way the sector or market blows, you'll be poised to benefit from it either way. Invest in bonds. Market crashes are a great time to invest in government bonds. These are essentially when you loan money to the government and expect them to return your loan with an agreed interest rate. These are generally considered one of the safest investment routes as the risks are relatively low. Now, low risks usually mean low interest, and that is the case with bond investing. Still, investing in bonds is a smart move as you can sleep easier at night knowing the government's history of flawless repayment. You can buy bonds from a broker or through retirement and investment accounts that offer bond funds, which include government bonds. Conclusion: there are a few things you can do to prepare and protect yourself for an oncoming market crash. Have a plan, understand your portfolio strengths and weaknesses, know your risk tolerance, and know what you want to do with your money. As discomforting as it may sound, economic crises happen occasionally, and market crashes are bound to happen. Those with foresight and the quickness of mind to act accordingly to the market are the ones who benefit the most, while everyone else in the market grapples for footing. With the tips shared in this video, you too can become one of those that profit from stock market crashes.
Alright guys, give this video a thumbs up if you learned something new. Share and subscribe to encourage the work that we do. Don't forget to check the description below for our Telegram channel link, where we would be sharing fascinating crypto information. Till I see you again, stay curious and keep learning.